Paradise is a boutique investment manager founded in Sydney, Australia in 1999. It has a unique and uncompromising focus on investment performance with capacity-constrained products and key individuals who only focus on their products and strategies. I joined Paradise 2.5 years ago from running international equities for the last 20 years. Global small caps is a unique asset class, primarily because of the size of the opportunity set. So we have the ability as fund managers to go where we can find the value. And so the marketplace is very large with emerging markets in Europe and Asia, and this opportunity set leads to better investment opportunities and the ability to compound. Secondly, as most fund managers that run mid and large cap strategies can't access a smaller end of the market cap curve by virtue of how much FUM they manage. And so we are a strategy solely dedicated to managing money in the smaller end of the market cap curve. Third, small caps have outperformed large caps over a long period of time. So this is an asset class that you should be able to compound at higher rates of return in an absolute sense. We find that those higher rates of return come through the inefficiencies in the asset class, i.e. there's not many people following a lot of these companies. They're spread out all over the geographies. You have country-specific analysts following these that lead to better opportunities to compound. Lastly, the valuations right now are very compelling in this asset class. We find that valuations are less than large caps, again, which should lead to better compounding over time. Because the market is so large, we feel that there's no way to access and have an opinion on every single company in the small cap end of the marketplace. And so we go the other direction, and we have a small team of 3 people, of key decision makers that look for something very specific in the small cap space. So we think if you're going to compound and generate alpha in this asset class, is you need a small team of people focused on finding their best ideas in a very large universe, whether that's emerging markets or Europe or Asia, focused on finding a key set of attributes for which they can compound at these nice risk-adjusted rates of return. Again, we are a dedicated small team. We only do this. We're a small team that only focuses on the smaller end of the market cap curve with 50 to 60 investment opportunities that are benchmark agnostic for which we can compound. One example is Bing Ray in South Korea. Bing Ray is one of the largest ice cream and yogurt manufacturers in the South Korean market. We found this opportunity through initial screens of South Korea and from subsequent trips to the country looking for investment opportunities. Again, Bing Ray has about 40% market share in the South Korean market. It's got brands that have been around for a very long period of time. It has high returns on invested capital. So this is a franchise business with business model longevity that fits right up our alley. Secondly, because it's run by a family, it's a conservative business by nature. They have net cash. They pay a very high dividend yield, and it's a management team that's been around for a long period of time. We were able to buy this business at a very cheap valuation because of some of the risks in North Korea at the time. Those risks have clearly dissipated with the changeover there. And this is a business that is now growing outside of South Korea very nicely in the Chinese and the American market, and again has been able to compound for us at a very nice rate of return. Again, the business franchise value, if Nestle or Unilever were to buy this asset, is substantially higher than the price that we paid for the business at the time. We've been able to compound at the higher rates of return of small cap, and in fact we've been able to exceed our benchmark quite extensively over the last few years, but with the downside protection that you would expect with strong balance sheets and franchise value. So our downside has been preserved much like a large cap end of the market cap. Yeah, the perceived risks oftentimes come across as liquidity risks and too much volatility. I think for us, we characterize risk as the permanent loss of capital, like anybody else would. If you lose money, that's your key risk. And so we mitigate that risk by, again, in our philosophy and process, we look for a strong balance sheet and we pay the right price. We have to pay substantially lower valuation multiples to be able to protect the downside. In terms of liquidity, we limit the liquidity risk by a small amount of investment names and by making this a capacity constrained product, i.e. we're going to shut the strategy down at $2 billion such that we can continue to move in and out of these investment opportunities without sacrificing liquidity. In terms of volatility, because of our process is focused more on compounding at these risk-adjusted rates of return, we haven't seen the volatility downside that some would equate to the smaller end of the market cap. We think this is a unique strategy because it opens up the world to investment opportunities. Again, we have access to emerging markets when we can find the valuations that are right. You get access and exposure to different sectors and geographies that you don't have access to in the Australian marketplace. Secondly, we're a team of 3 people that is solely focused on this. This is a dedicated strategy to looking for our 50 or 55 best investment opportunities all over the world. Third, the valuations are very compelling at the moment. So with the strong Australian dollar because of commodities and some of the perceived risks in places like Europe and China, is the opportunity set for us is quite large, and the valuations that we're paying are very compelling over a long period of time. We think now is a very good time with the prices that we're paying to be able to compound at these nice risk-adjusted rates of return.